Every institutional constraint in the global financial system is simultaneously a liability for the regulated entity and a structured profit opportunity for an unconstrained counterparty. Consider a pension fund governed by a strict duration mandate, a commercial bank dealing with an asset liability management or ALM mismatch on its deposit-funded mortgage book, or a liability-driven investment fund bound by rigid margin covenants. Exploiting these constraints is not a metaphor. It is a documented, recurrent mechanism with a 27-year paper trail. Institutional finance operates on forced transactions. A regulatory breach or outright insolvency is worse than executing a trade at a bad price. Because these entities must transact at scale to survive, they create a permanent, predictable flow. Hedge funds build their business models around monetizing that exact flow. Federal Reserve data from late 2024 documents that offshore Cayman hedge funds held $1.85 trillion in Treasury positions. This massive footprint is driven almost entirely by the Treasury cash futures basis trade. This chart shows how institutional demand creates the trade. On the left side, pension funds and bond mutual funds need to hold duration to match their long-term liabilities. But instead of buying cash bonds, they route their actual capital into higher-yielding corporate bonds and synthetically meet their duration mandates by buying Treasury futures. This immense mandate-driven demand pushes the futures contract to a persistent premium over the underlying cash bond, shown on the right. Hedge funds step in to bridge this pricing gap. They buy the cheapest-to-deliver cash bond, the specific bond that minimizes the cost of delivering into the futures contract, and simultaneously short the expensive futures contract. This locks in the gross basis spread between the two prices. To make a narrow spread highly possible, funds finance the long cash bond using overnight sponsored repo. They borrow at the Secured Overnight Financing Rate, or SOFR, the benchmark interest rate for dollar-denominated derivatives, minus a small spread, leveraging the position up to 50 to 1. Relying on overnight funding creates systemic fragility. In March 2020, as the COVID-19 shock triggered a spike in repo margins, basis traders were forced to liquidate. This forced selling prompted the Federal Reserve to step in with an emergency quantitative easing program. Despite the crash, the basis trade still exists and continues to grow. The basis persists because the institutions creating it face structural fiduciary mandates. They must acquire synthetic duration, regardless of the cost extracted by the hedge funds on the other side of the trade. This dynamic extends beyond fixed income arbitrage into directional equity trades. The collapse of Silicon Valley Bank in March 2023 was a highly legible asset liability failure. The data required to short the bank was fully visible in public filings 8 weeks before the FDIC seized it. This minimalist balance sheet illustrates SVB's Q3 2022 10Q filing. The bank held only $11.5 billion in tangible common equity. That equity was entirely eclipsed and crushed by $15.9 billion in unrealized losses on its held-to-maturity, or HTM book, an accounting category for bonds a bank intends to hold until they expire. Mark-to-market, the bank was already insolvent. The fatal catalyst was hidden in the footnotes. SVB publicly disclosed it had removed its interest rate hedges to boost short-term earnings. Combine that unhedged risk with a highly concentrated depositor base of cash-burning venture capital startups, and forced bond sales to meet withdrawals were a mathematical certainty. This exact logic applies to sovereign bond markets. In August 2023, Bill Ackman's Pershing Square executed a massive short position against 30-year U.S. Treasuries. The thesis tracked 3 vanishing institutional bids. The Bank of Japan relaxed its yield curve control, removing a massive institutional buyer of U.S. debt. Chinese and official sector accounts were reallocating away from treasuries, and U.S. domestic structural mandates were shrinking. These shrinking bids collided directly with an incoming supply shock. The U.S. Treasury announced a planned $1 trillion bill issuance, flooding the market exactly when structural demand was contracting. To execute the trade, Pershing Square purchased long put options on 30-year treasuries. This instrument selection maintained a finite, strictly defined downside risk, limited to the premium paid for the options, while capturing the convex asymmetric upside of the resulting yield spike. In both the SVB equity short and the 30-year treasury short, the profit generation relied on a specific mechanism. It required mapping out exactly when an institution's mandate would collide with a shrinking liquidity pool and positioning capital there before the forced transaction occurred. The United Kingdom's defined benefit pension sector manages approximately £1.6 trillion in liabilities. To match these 30 to 50-year obligations, the sector heavily utilized leveraged liability-driven investment, or LDI, strategies, funding long gilt positions through repo markets. In September 2022, the UK government announced a mini-budget that triggered a severe market shock.
Gilt yields spiked by 100 basis points in just 4 days. This rapid yield increase broke the LDI fund's models. The resulting margin calls forced the pension sector to liquidate approximately £25 billion in gilts over 5 weeks, irrespective of the market price. A Bank of England working paper confirmed the other side of this trade. Hedge funds, many of which held pre-existing short positions, stepped in to absorb the fire sale gilts. The central bank's own data notes these funds were directly compensated for providing liquidity to the distressed sellers. When margin covenants legally force an institution to sell assets at any price to remain solvent, uncapitalized constraints dictate the clearing level. The market structure forcibly transfers wealth from the constrained institution to anyone willing to provide balance sheet capacity. However, identifying a structural flaw does not guarantee a profit. The execution must align with the counterparty's institutional power.
Heyman Capital's Japan Macro Fund built a thesis entirely around a demographic liability crisis. The structural diagnosis was precise. Japan's aging demographics meant its pension funds were turning into net sellers of Japanese government bonds. To fund the deficit, the Bank of Japan would be forced to either monetize the debt or devalue the yen. The fund allocated its capital across 2 instruments. 2/3 went into put options on Japanese government bonds, and 1/3 was allocated to short yen, long dollar foreign exchange forwards. The Bank of Japan responded with massive quantitative easing. This completely suppressed bond yields, causing the put options to expire worthless. But the easing successfully devalued the yen by 40%. The minority foreign exchange allocation generated a 250% return for the entire fund. To see the ultimate failure of financing architecture, we have to look back to long-term capital management in 1998. LTCM's core directional thesis was perfectly correct. They recognized that the pricing spread between liquid on-the-run treasuries and illiquid off-the-run treasuries, as well as broader swap spreads, were anomalous. Over time, those spreads did eventually converge, exactly as the fund predicted. The fatal flaw was the funding structure. LTCM financed a multi-year convergence trade using overnight repo agreements at 50-to-1 leverage. This duration mismatch guaranteed margin insolvency long before the thesis could successfully play out. When a central bank is your adversary in a rates trade, or when your financing duration is shorter than your convergence horizon, being directionally correct is irrelevant. Earning alpha requires structural alignment between the thesis and the financial instrument used to express it. The ultimate expression of mandate-driven alpha is earning risk-free carry off an anomaly permanently locked in place by banking regulations. The 30-year U.S. swap spread has been continuously negative since September 2008. This line chart tracks the 30-year swap spread. After crossing below zero in 2008, it has averaged negative 23 basis points for over a decade. This is driven by price-insensitive demand. Underfunded defined benefit pension plans systematically receive fixed rates in 30-year swaps to extend their asset duration, requiring only margin posting rather than a full capital outlay. The market hasn't corrected this obvious arbitrage because of the supplementary leverage ratio, or SLR. This post-Basel III banking regulation makes holding the offsetting cash treasury bonds too capital expensive for primary dealer banks, creating a rigid barrier that prevents them from arbitraging the spread away. Hedge funds step into the void. They execute a carry trade by paying the fixed rate in the swap, receiving the floating SOFR rate, and buying the higher-yielding treasury bond via repo. Because the swap spread is negative, the treasury yields more than the fixed rate paid out, locking in positive carry from day one. Strict regulatory capital constraints on the major banks act as a protective moat. They permanently lock in positive carry for shadow banks and unconstrained funds operating with lighter balance sheets. These mechanics are not isolated incidents. They represent 27 years of data spanning 5 countries and 4 major asset classes. Unconstrained capital plays 3 distinct roles in the global market. The first is directional prepositioning, carefully reading public balance sheets to front-run a forced transaction before it crystallizes, as seen with Silicon Valley Bank. The second role is distressed liquidity provision.
This is the willingness to buy the exact assets that margin covenants and mandates force other institutions to sell at fire sale prices, absorbing the shock when systems break. The third role is structural carry, sitting continuously opposite mandate-driven flows, earning a permanent spread shielded by the regulatory limits placed on primary dealers. Alpha is not clairvoyance, it is not macro guessing, and it is not luck. Alpha is simply reading the rules that other institutions are forced to follow, and having the balance sheet to stand on the other side.